Friday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming we're going to have Donny Gilbert giving us an update for the brokers. We also have Andrew Cox back with us with a DHL Supply Chain Pricing Power Index update. But first we're going to go to Zach Strickland with a carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Friday carrier update presented by PowerFleet. I'm Zach Strickland. So everybody's been talking about the coronavirus and all its impact to the United States domestic economy. Now, we don't really know what that's going to mean just yet. So what does that mean for a carrier to look out for here in the coming weeks? So I've got behind me the Freightos Baltic Exchange Index, which represents the average spot rate for a 40-foot container moving across the ocean coming from China to North America's east and west coasts. So the east coast rate is represented in the green line there, and the west coast rate is represented in the blue line. Now we can see clearly that both of those rates have dropped dramatically, almost $200 or roughly 15% a piece since this time last week. What that means is, the thing that you can't tell here is that a lot of those carriers, the ocean carriers, have reduced their capacity dramatically, but they're also reducing their rates, meaning that there's not as much freight coming across the ocean as there was, not able to maintain their elevated rate structure. So anybody that operates around the ports really needs to be paying attention to this, but anybody in general that moves retail freight, anything that originates across the ocean into China, really needs to be paying attention to what this is going to mean for them, as demand may not necessarily show up in the form of freight movements across the country here in the next few months or so. A lot of this freight moves in June, July, August. A lot of that stuff gets ready for the holiday season, retail peak, and all that kind of stuff. So really, as we watch throughout the year, we need to pay attention to what's going on across the ocean in China. And right now it looks like we may be seeing some sort of lagging effect. It has not necessarily shown up yet in terms of truckload volumes or freight volumes. We can see here, this is the outbound tender volume index for both Savannah and Los Angeles markets, both heavily weighted towards port activity, import activity. And you can see here that in November, both of them really, or earlier, I guess, for Savannah, if you look at this orange line here, they both fell off dramatically in terms of overall freight volume and have not really recovered since. So that's a lot of the trade war impact that's going on right there. But this could mean that here in the next month or so, volumes could drop even more in both of these markets. So if you are operating out of there, you definitely need to pay attention to these two markets. Going on in the rest of the country, all the weather systems for now have moved off the coast there, out into the southeastern, Atlantic. And then up here in the northwest, there will be some weather coming across later on this weekend. So make sure anybody in the mountains, definitely make sure that you got your chains going and stuff like that. But tender rejection rates, weighted rejection index showing up blue a lot in the southeast. A lot of activity going on in the southeast right now. It's a little early for us to see any significant impacts in southeastern freight volumes just yet, but we did see a slight increase in activity down here over the course of the week. We talked about Atlanta, Mobile, Savannah, all had slight increases week over week in terms of volume. Also tender rejection rates week over week. If you notice the blue here, that means that they are increasing week over week, and they do have significant volume behind them, hence the darker blue color there. So I want to focus in on the Nashville market real fast, because tender rejection rates for both reefer and dry van really picked up this week. Over 7% dry van tender rejection rate, and then well over 16% for the reefer rejection rate out of the Nashville market. Now, reefer activity not as prevalent there, but it does represent about 10 to 15% of overall volume in those areas. So make sure that if you are operating out of the Nashville market, to watch out for increasing spot market activity. Anybody that's heading in there should definitely check the load boards and also hold those margins a little bit more firm than you normally would. You do not have to drop your rate significantly. Tweener rejection rates are the ones leading the way, so those are going to be your 450 to 800 mile loads. So some decent paying freight coming out of Nashville right now. And that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Thank you, Zach. My name is Donny Gilbert, and I'm going to bring you the brokerage update for today. It's Friday. Most of your drivers want long hauls on Friday, so I'm going to bring you a map that has our long haul outbound tender rejection rates and our long haul volumes. So kind of looking at this map here, we see a lot of states that are very lightly colored that have the volumes. Starting out here in southern Florida, Miami, Lakeland, they have a lot of volumes for long haul rates, for long haul loads, but the rates on those loads are currently right now very, very low. Tender rejection rates are in a lot of these areas are less than 3%, meaning that spot market rates are below contracted rates. But looking across here, we see a lot of up here in Harrisburg, PA, Ohio, Juliet, and Chicago, of course, have a lot of volumes. Down through here, Memphis, Dallas, Texas, Houston, Texas, some out here in Denver and Salt Lake, and also on the West Coast. So where you see a lot of your higher volumes, you see though a lot of low tender rejection rates, and that's because long haul loads are the loads that are most preferred by your over-the-road truck drivers because they're paid by the mile. So of course that keeps the truck moving, sometimes 2 to 3 days, and of course the fleet manager doesn't have to worry about rebooking that truck every day, so they enjoy it as well. Let's take a look at overall at how the long haul market is doing right now. We see volumes are picking up right now, which is good for the long haul market, especially for the second week of February. We've seen this kind of steady growth here, picking back up after it kind of dropped down here a little bit during the middle of the month. And of course, next week is the last full week of the month, so we're heading into the end of the month, so we hope to see these volumes continue to rise. Now, tender rejection rates, well, they started to pick back up, and they kind of dropped back over here. They're at 5.44%, so overall, the average across the U.S. Is about the same as a contracted rate, so nothing booming, and it hasn't dropped too low yet, but my concern is it is kind of trending downward right now, but hopefully as we get into next week, it will also start trending back up because of the end of the month. Now, just taking a peek here at our long haul, some of our big markets, we got Los Angeles is at 2.31%. So that again tells you it's below 3%. Your spot market rates are below contracted rates in Los Angeles, Dallas, Chicago, and Atlanta. All these rates are below contracted rates. Two that I really want to talk about is Harrisburg, PA, and Chicago. Chicago here, or not Chicago, Memphis. Memphis here is the green line. It has started to pick up. It is up to 7.65%. So right now, spot market rates have just crossed over what contracted rates are. This is a market that I want to keep an eye on, especially maybe through next week. See if you can pick up some loads early in the week or through the middle of the week for long haul, because rates are picking up. You know, hopefully they'll get closer to 10% where you can make a little bit of extra margin. Now, in the Harrisburg market, the purple line here, you're seeing it pick up, and then all of a sudden you see it dropping back down, very sharp right here. Well, if your shipper's using a rating tool right now and they're 7 days behind, this is where the rates are showing right now from a rating tool perspective. So you might be able to bump your rates up only because they're 7 days behind. Bump your rates up to the shippers in the Harrisburg market. Now, dropping back down, the carriers are seeing the rates drop. Push the carrier rates down. This might help increase your margins because they're already seeing the pressure from the rates falling. Last but not least, we'll jump into the Miami market. This is my market of the day. Miami has seen a increase of about 32% year over year from 2019. We've had a lot of imports coming in the Miami market, which is affecting both rail and outbound truckload carrier. Now, the rates in Miami are very, very low, of course, but if you can jump in, extra volumes, there's more opportunities. If you can jump in and get some of these loads booked, tweener haul loads or long haul loads, you're going to be able to push these truckload rates down to get coverage on your loads out of Miami. There's a lot of extra capacity in the Miami market. So if you're able to go in, look at the spot market because their tender rejection rates are below 2%. So that means a lot of your loads will be moving over to the spot market to get cheaper rates for the shippers. So jump in there, find these loads and book them. Then flip it over and find you a carrier, push their rates down, because a lot of carriers will actually run out of Miami empty because they don't want to lay the truck over waiting on freight. So just turn it right back around and bring it back up north. That's going to do it today, guys, for our brokerage update. Thank you.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the Freight Tech Revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
With Andrew Cox. Andrew, what do you have for us today?
Tony, it's Friday, so we got the DHL Supply Chain Pricing Power Index. Our article came out yesterday. it has fallen another 5 points towards the shippers. The shippers are now in a dominant control position of the pricing and bid negotiations between the shippers and the carriers.
So this was a move back from last week. What were some of the driving or not so driving factors for this move?
Yeah, if we want to look at it from another week, we fell down from 25 to 20. You know, this has been on a little bit of a ride after right before Christmas. We jumped up to a controlling position almost for the carriers. They had a lot more pricing power. There was a lot more capacity. I mean, a lot less capacity and more volume right there before Christmas. But if you want to look for the last month, it's just been flat. We haven't had much to write about on the capacity nor the volume side for the DHL Supply Chain Pricing Power Index. And this week, it wasn't so much a case of bad news that the data came back as worse than it was the previous week, but it's just continuing deterioration of a bad environment for carriers.
Right, and one of the things that we're looking at, you said this was flat. Another area in the general economy, we didn't see a lot of stellar results there over the week, right?
Right. We've just seen kind of lukewarm economic data. We had some strong housing data. You know, employment's still strong. The economy's still good, but that doesn't give carriers any pricing power in their negotiations. We're looking here at volumes and capacity. If volumes can go up while capacity can stay the same, then we're looking at increased rate pricing power for the carriers and vice versa. Right now, we're just seeing capacity still really loose throughout the entire country on both reefer and van portions of the industry, but you know, our outlook is a little bit brighter. We're looking at our 3-month outlook, which would be mid-May, and we're thinking that it will be somewhere around 55. This isn't our chart, but somewhere around 55, 50 would be a balanced market. So we do think the carriers will be in power in about 3 months.
Right, and so you mentioned that outlook, some upward movement there, or some move to the other side of the pendulum. What are some of the driving factors really behind that thinking?
Well, we think the impact of the coronavirus will be kind of already gone through its phases, and we'll have a lot of the influx of the volumes that are kind of stuck in drayage and stuck in Chinese ship ports right now. We think most of that will be coming through to the West Coast and some to the East Coast, and that's going to create an influx of capacity at the same time, an influx of volumes, at the same time that we have produce season hitting, and we also have summertime coming around where people will be drinking a lot more beverages and increasing consumption. So we just think that there'll be almost a capacity crunch. We're going to have a lot of volume coming in, and we do think that some of the capacity will churn with this drug clearinghouse and some of the company closures we expect because of higher insurance rates. We just think it's kind of a lot of things happening at the same time there in May and June.
Got you. So quick summary, as of now, a very slow start to the year. Not necessarily bad news, but flat news, and not a lot happening, and that's really holding things down. But we expect this to really start to pick up in the coming months and moving into that midpoint of the year of 2020.
Yeah, precisely. We do believe that the second half and even the summer and second half of 2020 will be much better for the carriers. Right now, the shippers are in dominant control. They have been for a while now, but we do think things will ease up and we'll get some of the pricing power floating towards the carriers here in a few months.
Excellent. Andrew, thank you so much. And thank you for tuning in. That's going to do it for this DHL Supply Chain Pricing Power Index. Be sure to tune in next week for another update. Much for tuning in. That's going to do it for this Friday edition of FreightWaves Now, but the fun does not stop here. We're always streaming around the clock, so check out our FreightWaves TV app on all your favorite platforms, including Apple TV. Also, if you're looking for a little bit more deeper insights, check out our new Passport program. You get more insights from the guys like Andrew Cox here and his great research team, and you get access to our world-class events like our upcoming FreightWaves Live in Atlanta in May. Thank you so much for tuning in, and we'll see you on the next episode.
Is the trade war back on?
Trade war.
Trade war, full-blown trade war.
15% tariffs on $112 billion worth of goods.
Hours earlier, China announced tariffs of 5% and 10% on U.S. products.